Let me ask you something, and answer honestly. Have you ever taken a trade where everything looked right? The setup was clean, the crossover was perfect, and yet the market stopped you out like it knew exactly what you were about to do? Not once, not twice, but so many times that you stopped getting angry and started feeling tired. Here's the part nobody talks about. It's not the big losses that mess traders up. It's the small ones, the ones that look harmless. $10, $20, $50. Losses small enough that you don't panic, but frequent enough that your account slowly bleeds. And every single time, the chart does something cruel. You enter the trade. The market moves against you just enough to hit your stop. You're out. Then, and this is the part that hurts the most, price turns around and moves exactly where you predicted. Not close, not almost, exactly. So now you're left with two thoughts fighting in your head. One says, my analysis was right. The other says, then why am I still losing money? That's when the real damage starts. You stop trusting the strategy. Then you stop trusting the indicator. Then you stop trusting yourself. You change time frames. You add indicators. You remove indicators. You chase entries because you're scared of missing the next move. And slowly, without realizing it, you turn from a trader into a button clicker. Click, hope, lose, repeat. At some point, you start believing the market is rigged, that it's designed to take retail traders' money, that stop losses are hunted on purpose. But here's the uncomfortable truth. The market isn't hunting you. It's reacting to something you're not seeing. Because while you're waiting for confirmation that shows up after the move has already started, professional traders are watching something else, something quieter, something earlier, something that tells them whether a move has real intent behind it, or if it's just another fake push designed to trap impatient traders. And no, this isn't a paid indicator. It's not a secret algorithm. It's not something locked behind a course. It's been sitting in your platform this entire time, ignored, misunderstood, skipped over. When I finally understood what it was actually measuring, two things happened. First, my losing trades stopped feeling random. Second, I stopped entering trades right before they failed. Not because I became smarter, but because I stopped entering at the worst possible moment. If you keep trading crossovers the same way you are right now, you'll keep getting the same results. But if you understand what I'm about to show you next, you'll finally see why some crossovers explode and others die the moment you enter. Let's break it down. So here's what we're covering today. First, I'm going to explain why EMA crossovers fail most traders and how professionals think about them differently. Then, I'm going to reveal the confirmation tool I've been teasing and break down what it actually measures in terms you can visualize. After that, I'll give you the exact rules for entries and exits, walk you through 2 real trade setups, and show you how to avoid the mistakes that kill accounts. Before we go further, if this type of content helps you, hit that like button. It pushes this video to more traders who need it. And if you're serious about leveling up, subscribe and turn on notifications. I release breakdowns like this every week. Now let's get into it. So let's talk about why crossovers betray you. The EMA10 and EMA20 are solid tools. The EMA10 tracks short-term momentum. It's fast. It reacts immediately to price changes. The EMA20 is smoother. It represents the broader short to medium-term trend. When the EMA10 crosses above the EMA20, it signals that recent momentum is accelerating upward. That's bullish. When it crosses below, momentum is shifting down. That's bearish. On paper, this makes perfect sense, and it does work. But here's the trap. A crossover tells you what already happened. It doesn't tell you if the momentum is strong enough to continue. It doesn't tell you if big players are involved or if it's just a temporary spike caused by low volume or a news headline that fades in 5 minutes. Let me put it this way. Imagine you're watching someone start running. They take 3 fast steps. Does that mean they're about to sprint a marathon? Or are they just running to catch a bus and they'll stop in 10 seconds? The crossover is those 3 fast steps. It shows movement, but it doesn't show you stamina. It doesn't show you commitment. And in trading, commitment is everything. You need to know if the momentum behind that crossover has strength, if it has follow-through, if institutional traders and smart money are actually participating, or if you're just riding a retail fakeout. This is where most traders make a fatal mistake. They see the cross and they enter immediately. They don't wait. They don't confirm. They just pull the trigger because they're afraid of missing the move. And that fear costs them money, over and over again. Professional traders don't do that. They wait. They confirm. They measure the strength of the move before risking capital. And the tool they use to measure that strength? It's called the Commodity Channel Index, CCI. Now, don't let the name scare you. This isn't some advanced quantum physics indicator. It's simple, it's visual, and once you understand what it measures, you'll never trade a crossover without it again. Alright, so what exactly is CCI? The Commodity Channel Index was designed to measure how far the current price has moved away from its average price over a certain period. Think of it like this. Imagine you're tracking the temperature outside. Most days it's around 70 degrees. That's the average. But some days it jumps to 85, and some days it drops to 55. CCI measures those deviations. It tells you when price is stretching beyond its normal behavior. Here's how it shows up on your chart. CCI oscillates around a zero line. When it's at zero, price is trading right near its average. Nothing unusual. When CCI moves above zero, price is climbing above its average, which signals bullish momentum is building. When it spikes above plus 100, price is significantly above average. That's strong bullish momentum. On the flip side, when CCI drops below zero, bearish momentum is building. And when it falls below minus 100, that's strong bearish pressure. Now here's the key insight that changes everything. If you skip this part, the strategy will fail. CCI often crosses above zero before the EMA crossover happens. Read that again. Before. This is your early warning system. It's telling you momentum is shifting before the crossover confirms it. While retail traders are waiting for the EMAs to cross, professionals are already watching CCI build momentum. They're preparing, they're sizing up the trade, and when the crossover finally happens, they enter with confidence because they've already seen the confirmation. This is the edge. This is what separates beginners from professionals. You're not guessing. You're not hoping. You're watching momentum build in real time, and you're only entering when both signals align. So let me be very clear. From this point forward, you never trade an EMA crossover without checking CCI. If CCI hasn't confirmed the move, you don't take the trade. Alright, now let's get practical. I'm going to walk you through exactly how to add these indicators to your chart. This is simple, but I want to make sure there's zero confusion. Adding the CCI indicator. First, open TradingView. At the top of your chart, you'll see a button that says Indicators. Click on it. A search bar will appear. Type in CCI, and you'll see Commodity Channel Index pop up. Click on it to add it to your chart. Now, here's something very important. When you add CCI, TradingView automatically enables a secondary line called the SMA line, or signal line. This is an extra smoothing line that shows up on the CCI indicator by default. We are not using that line in this strategy. It adds unnecessary noise, especially for beginners. We only care about the main CCI line and the zero level. So here's what you need to do. Click on the CCI indicator at the top of your chart where it says CCI 20. Click on the gear icon or Settings. This opens the indicator settings. Now go to the tab that says Input. In the Input tab, by default, TradingView sets the CCI length to 20. That's perfect. Leave it at 20. Don't change it. One of them is the SMA line or signal line. It's usually checked by default. Uncheck it. Turn it off completely. We don't want to see it. We don't analyze it. We don't use it. Keep only the main CCI line visible. That's the only line we're watching. Everything else is off. Now your CCI indicator is clean and simple. Just one line oscillating around zero. Next, let's add the moving averages to the price chart. Go back to Indicators at the top. In the search bar, type EMA or Exponential Moving Average. You'll see it in the list. Now click on EMA 2 times. First click, EMA applies. Second click, another EMA applies. Now you have 2 EMAs on the chart. Now we'll set them up one by one. Click on the first EMA settings. Set the length to 20. Source stays close. Change the color to orange. Click OK. Now click on the second EMA settings. Set the length to 10. Source stays close. Change the color to green. Click OK. Now you have 2 exponential moving averages correctly set. EMA 10 fast moving, shown in green. EMA 20 slower and smoother, shown in orange. That's it. Your chart is now set up properly. Alright, let's lay out the rules. This is where clarity beats confusion. For a buy trade, step 1. Wait for the EMA 10 to cross above the EMA 20. This signals bullish short-term momentum. Step 2. Check CCI. It must be above 0 at the time of the crossover, or it must have crossed above 0 shortly before. This confirms the momentum has strength. Step 3. Enter the trade only when both conditions are present. You can enter on the close of the confirmation candle, or if you want a better entry, wait for price to pull back slightly to the EMA 10 and enter there. Step 4. Place your stop loss below the most recent swing low or just below the EMA 20, depending on your risk tolerance and the volatility of the pair. Step 5. Set your take profit at least 1.5 to 2 times the distance of your stop loss. If you're risking 20 pips, target at least 30 to 40 pips. Always aim for positive risk to reward. For a sell trade, step 1. EMA 10 crosses below the EMA 20. Bearish momentum signal. Step 2. CCI must be below 0 at the time of the crossover or shortly before. This confirms bearish strength. Step 3. Enter when both align. Step 4. Stop loss above the recent swing high or above the EMA 20. Step 5. Target at least 1.5 to 2 times your risk. That's the system. It's simple, it's repeatable, and it works when you follow it without emotion. Now, what time frames should you use? This strategy performs best on the 15-minute, 1-hour, and 4-hour charts. If you're newer to trading, start with the 1-hour. It gives you time to think. You're not scrambling every 2 minutes. The signals are cleaner. The 5-minute chart works too, but it's faster and noisier. You'll see more setups, but you'll also see more fakeouts. If you're still building consistency, avoid the 1-minute chart completely. It's a graveyard for beginners. Stick to higher time frames. Build your edge. Then, if you want, scale down later. If this video gave you value, hit that like button. Drop a comment and let me know if you've been caught in the EMA crossover trap before. And subscribe if you want more breakdowns like this. Remember, this is educational content only. Trading carries serious risk. Never trade with money you can't afford to lose. Trade with logic. Trade with rules. And I'll see you in the next one.